This story here in Oregon Live involves LPL Financial, which is one of the biggest broker-dealers in the country. They just paid a $100,000 fine for violating a securities law in its oversight of a broker who sold risky alternative investments to seniors. It says one of their brokers, CPA, sold 71 partnership units issued by a Virginia-based company. Said these alternative investments weren't publicly traded or easy to resell, and they were highly speculative because they were interests in oil, drilling, and so forth. So basically, these investments are as risky as it gets. However, they were sold as perfectly safe ways to make money. CPA sold 20,000 of the partnerships to an 89-year-old man undergoing cancer treatment just 2 months before his death. CPA also sold 40,000 of general partnership units and 45,000 in corporate junk bonds to an 89-year-old cognitively impaired resident who CPA himself described as mentally lost and confused. It's absolutely unbelievable. So this person has admitted to taking advantage of people who did not have the ability to protect themselves. Never ceases to amaze me. Now, what does LPL do in all this? Because you think the biggest firm in the world, they would put the hammer down and really put this guy in place and make sure this doesn't happen. What do? It says LPL's alternative investments desk initially rejected some of CPA's transactions, which is great. Good job, LPL. Oh, but wait a second. But approved them after he claimed a sudden increase in his client's assets. Isn't that great? A compliance examiner also failed to review any of the partnership sales during a pre-announced branch visit. Well, if you didn't review those partnership sales, what did he do? That's my question. Very difficult to determine that. So here's another case. This is LPL, one of the biggest firms out there. They get fined $100,000, which is like finding Tiger Woods $1. It really, they price this in. They know that these fines are going to happen. They know that they're going to be small, so that's why things like this happen, and that's why the compliance officers don't examine anything. So it goes on to say that the state penalized CPA $100,000. Okay, so the state is hitting him with a large fine, which is great, but they suspended $70,000 of that fine as long as CPA complied with the state's order. So he only had to pay $30,000. So this is what happens. This is a typical example of the slap on the wrist. You're fined $100,000. You only have to pay $30,000 of it. However, if his investors lost $100,000, which I'm sure many of them easily could have or did, the story really doesn't specify, they're going to keep that whole loss, of course. So the court documents for this example here, this guy CPA, are also particularly interesting. He said a limited partner that invested $25,000 could lose no more than $25,000, which is correct. Anybody who buys a limited partnership interest, generally their liability is limited to whatever they invested. So if you put in $25,000, you can only lose $25,000, which is correct in most cases. There are, of course, legal exceptions, and this is definitely not legal advice, but generally that's what happens. The part that gets me about this story is he also sold general partnership interests, in which the general partner's risk of loss exceeded the amount of their principal investment and was unlimited. So what this guy did was he would call up seniors that he said themselves were mentally unable to assess what they were getting themselves into, and he sold them general partnerships which exposed them to unlimited risk, which means their house was at risk, their other savings were at risk, whatever other accounts they held could have been seized as well. So this is really a new level, because most bad investments out there, most of them, of course there are exceptions, they might cause you to lose 100% of your investment, which is horrible, which is absolutely devastating. But to sell general partnership interests, that's a new level, because now these clients literally could lose everything they put in and basically anything else that they own. So it shows that people that indicated that they were looking for conservative investments or moderately risky investments were sold junk bonds, basically partnerships that had very little chance of producing any real returns. And the question always asked is, well, why does this person sell all these investments with such devastating consequences? Well, the answer is commissions. every financial professional wants to make money, right? So this is just one way that brokers do that. This is another example of the suitability standard. I've been taking a stand against the suitability standard and stating that it's not in the best interest of investors. Now, of course, this is a case where even suitability was violated, but generally, if somebody was in a position where this kind of investment might seem suitable for them, then this guy might have gotten away with this. And if investors lost all their money and they were looking for something that was higher risk, then this guy wouldn't be responsible because it's pretty much within the suitability threshold. Investment advisors, just to point out, operate under the fiduciary standard, which is a much higher standard where you'd have to work in the best interest of the client at all times. And of course, commissions are definitely a driver in these investments. Generally, the riskier they are, the more lucrative they are for brokers selling them. So that's why somebody would partake in these types of investments. There are some mutual funds. They're no-load mutual funds, which means they don't pay a salesman anything for people to invest in that fund. And that says a lot about the fund because it implies that the managers of that fund are confident that they can earn investors and earn assets under management with performance, which makes a lot of sense. However, there are other funds that pay up to 5.75% for the upfront load, whereas the broker can make a large percentage of that and be incentivized to sell that fund, which they may not ordinarily have sold if there wasn't that compensation element. So that's a suitability standard at work. That's another example. Of course, this guy Kleck definitely exceeded even the suitability standard and violated that, but it's another aspect of what's going on right now in the industry as far as the separation between suitability and fiduciary standard. Now, the SEC has taken a stand earlier this year where, because of the Frank-Dodd legislation, it looked like they were going to unify the standards. And what I mean by that is take the fiduciary standard and apply it both to investment advisors and to brokers. And this, of course, would have killed the brokerage model because if you're earning commissions, you basically have a conflict of interest. And the conflict of interest would not be allowed under the rules. So in that case, the SEC looks like they're backing down. It looks like they're not going to enact such a strong standard. It might keep the suitability and fiduciary standards pretty much separate. They might look more similar to each other than they are now. And that's what really might be a problem for investors to differentiate exactly what they're getting into and what kind of financial professional they're actually dealing with. So there's also another story here in All Business where FINRA orders Chase to reimburse customers $1.9 million for unsuitable sales of unit investment trusts and floating rate loan funds. Unit investment trust is an investment product that consists of a diversified basket of securities which can include risky speculative investments such as high yield, junk bonds, and floating rate loan funds are mutual funds that generally invest in a portfolio of secured senior loans meant to entities whose credit quality is rated below investment grade or otherwise known as junk. So it says, with a growing number of complex products in the market today, it is incumbent upon firms to properly train and provide guidance to their brokers about the products that they sell and supervise the sales practices of their brokers. Chase allowed its brokers to sell risky unit investment trusts and floating rate loan funds without providing them with the training, guidance, and supervision necessary to determine whether these products are suitable for their customers, resulting in losses for Chase's customers. Now, not only didn't they train these brokers, but you have to think about the pitch. So someone's calling someone on the phone, pitching this product to them. The client asks, what is this all about? The person is going to say, I don't know. Chase didn't train me. I really have no idea. No, they're not going to say that. They're going to say, this is the best thing ever. This is going to change your life. It's going to put your kids through college. I'm invested in it myself, whether it's true or not. And I'll get the client really excited about it. It sounds complex. It sounds unique. It's a UIT. People generally haven't heard of it, but this is what happens. Now, in this case, it was great because Chase can afford to reimburse their clients, and they haven't disappeared. Other firms may have closed down or have not had the funds to pay their clients back. So I think they definitely lucked out in this respect. And FINRA, in this case, fined Chase $1.7 million, which is hilarious. A fine of $1.7 million for an institution like Chase is a complete joke. Is a complete joke. It's like receiving a traffic ticket for 5 cents. People would be going 100 miles an hour all the time. And if we think back to Goldman Sachs, they were fined $500 million not too long ago for their involvement in the financial crisis. And their market cap actually went up because of that, because a lot of people thought that the fine would be more significant and there would be much more far-ranging consequences of what happened. But the $500 million fine actually made the stock go up, and the firm as a whole became worth more because of the $500 million. So these fines, it just goes to show it's another slap on the wrist. FINRA is run by pretty much brokers anyway, so it's a closed loop. The financial institutions get the rules that they want, and FINRA gets the fees. It works very well. Unfortunately, investors are usually the ones holding the bag. In this case, it worked out well, but in a lot of these other cases that I've gone through, hasn't worked out so well.